It is time for Money Power Politics, and we have got a lot to dig into tonight, but I want to start with some major news in the Middle East. The United Arab Emirates announced today, pay attention to this, that it will officially leave OPEC in 3 days. The decision comes after weeks of Iranian missile and drone attacks that left the nation's oil production battered. Their departure is an enormous blow to OPEC. For nearly 60 years, the UAE has been an extraordinarily influential member of the oil cartel, and this move could inject fresh, potentially long-term volatility into an already fragile economic situation. My dear friend Brendan Greeley joins us. He is a contributing editor for the Financial Times, and Max Chafkin, Bloomberg Businessweek journalist and host of Bloomberg's podcast, Everybody's Business. Okay, Brendan, slow this down and talk to us as non-OPEC experts, maybe even OPEC borderline. Non-OPEC experts. We'll leave it at that. What does this mean for oil prices? Does it put OPEC at risk?
It does. And I just want to underline what you said earlier. This is a shocker, really, just mouths open all over markets all over the world this afternoon after the announcement. The important thing to remember is that not all oil producing economies are the same. Not even all Gulf oil producing economies are the same. So one of the things that the UAE has going for it is that it's done a much better job than the Saudi Arabians of diversifying its economy away from oil. So when you look at their non-oil GDP, this is from things like financial services, travel, tourism, they're growing at a much higher rate than the Saudis are. So what that means is they have a lot more flexibility to make money and actually run their economy outside of oil. So oil analysts talk about the break-even price of oil. What that means is what's the lowest possible price at which you can still productively run your economy and make ends meet. All of this adds up to a real problem for the Saudis, which is that the UAE has a lower break-even price than the Saudis. It can drive the price of oil down farther and still make ends meet. Saudis are running deficits right now. UAE is running surpluses. So none of this is going to make a difference until the Strait opens back up. After the Strait opens back up, what analysts think we're going to see happen, the people who follow oil, is that the UAE is going to absolutely pump everything it can as quick as it can. And if you can do that, you can drive the price of oil down. And if you can survive a lower price of oil better than the Saudis, it means that the UAE is in the driver's seat for the price of oil, even though they're only 10% of OPEC production. This is a huge blow. And what it really means is the Saudis are no longer in charge of the price of oil.
You also wrote about the petrodollar for the Financial Times. Why is this system so important for us to understand? And how could this shake up with OPEC affect it?
Well, so there are two ways in which oil affects the dollar. One is since the beginning of the oil boom in the Middle East 60 years ago, oil has always been priced in dollars. Now, there are some conspiracy theories about that, but the easiest way to point out is that there was no alternative and there remains no alternative. There's just no other market as liquid and deep as the market for dollars. The other thing that's interesting, though, is that relatively early on in the 70s, the Saudis came to an arrangement with the United States to sink a lot of that wealth that they had from oil into treasuries. Now, that's what's really important. One of the things that Scott Bessent has made clear is he wants to make sure that there's always a market for U.S. treasuries, for U.S. debt. So once you get into the geopolitics of this, the UAE has come to the United States Treasury and asked for a swap line. This is just a temporary loan in dollars. So what we're actually playing with here is the ability of other countries to come to the United States and say, okay, we're going to continue to base our economy on dollars. We're going to continue to peg our dirham to the dollar, but we're going to need something from you in return. And we're starting to see more and more often the United States Treasury is offering these short-term loans, swap lines, for explicitly political ends, in this case, to support the UAE. So the UAE is coming to us with an offer, and we have something to offer back. And the price, or rather, the value of the dollar rests on the ability of the Treasury Secretary to continue to sell treasuries. And this is a small piece of that puzzle.
All right, new topic. This OpenAI trial, which I'm going to say I never thought would happen. I absolutely thought the Sam Altman, Elon Musk battle royale would settle before they're actually in court. But no, Elon Musk, with all that he has to do, on the witness stand today, testifying about his former company and why he left. What were your big takeaways?
I mean, it is kind of shocking to see these two guys who have so much at stake. I think it's ego, first and foremost. Elon Musk especially, but also Sam Altman. Both these guys see themselves as pioneers. They're very invested in that. It's also about money. Both of these companies are scrambling to go public. SpaceX, which owns Elon Musk's AI company, is going out to bankers right now, trying to convince them, that they should value this thing as high as $1.5 trillion, which is really high relative to the revenue. Sam Altman is doing something very, very similar. And OpenAI is also going to be trying to go public at an absurd valuation, at least by, conventional financial metrics. And I think the third thing where there's a rivalry is kind of for access to Trump. Elon Musk, of course, famously very close to the president at the beginning of the administration. Greg Brockman, who's named in this lawsuit, who's the president of OpenAI, has been the biggest donor to Trump. So you have a battle for influence, you have money, you have ego.